Hey, good evening, everybody. It is about a minute late. Sorry for that, but we're gonna get things kicked off right now. And there's still some people who are checking in, but we're gonna go ahead and get started. They can stream in as we go. But welcome. If you are coming back after seeing sessions 1 and 2, welcome back. We're excited to have you. If you're dialing in for the first time, and this is workshop number 3, I'm going to encourage you to go back and also watch sessions 1 and 2. You'll have an opportunity when we're done tonight to get access to the replays, and I will do a quick high-level overview of what we covered in the past. So again, welcome. My name is Greg Maddox. I am Senior Business and Exit Advisor with Cultivate Advisors. A little bit of housekeeping. We have a few team members on the call right now. We have David, we have Matt, we have Kyle. So if during the presentation you hear me either shouting out to them or hear some other voices on the presentation, just know that those are other folks on the Cultivate Advisor team. And they'll be manning the control panel, looking at, you'll have the option, if you're not familiar with GoToMeeting or GoToWebinar, there's a control panel there where you have a question section. Think about like a chat, and that's where you can pose questions, and someone on our team will bring that to the forward for me, and we have another presenter, special guest tonight as well. And so without further ado, for those of you who don't know, Cultivate Advisors, we are a business advisory firm that's staffed by current and former business owners, and we partner with founders and owners who've got a strong desire to scale, sell, or passively own their companies, but they want to do it years ahead of schedule. And in the process of doing that, we actually create what we call business owner freedom today, but also with an eye towards creating maximum value when it's time to exit. And we do that through structured collaboration with the entire exit planning team of advisors. And today, you're going to get a real sense of what we mean by the team of advisors. And the purpose of our workshop series is really just to break down the exact steps and process that we follow with our clients to accomplish this. And for those who might not be aware of us, we have actually worked with over thousands of business owners all across North America. We've made the Inc. 5000 4 years in a row for fastest growing companies in the US. We have hundreds of 5-star Google reviews, as well as a world-class net promoter score. So I share all of that just to let you guys know that the work that we actually do with our business owner clients, this is not theory for us. We actually drink the Kool-Aid, eat our own cooking, and everything that we're doing and helping our clients do is the same exact stuff that we're doing ourselves at Cultivate to scale our business to an eventual exit. So let's jump into what we're going to cover today. Let me move the control panel. There we go. So a quick recap from last week. So last week we covered step 3, and let me just, I'll come to this, move the slide forward 1. So last week we covered step 3, which is know your business. And during that time, we talked about how to look at your business through the eyes of a third party. The week prior, we covered steps 1 and steps 2. Discover your freedom point, which is determining how to fund your lifestyle without your business. And more importantly, how do you accelerate results? Step 2, that's creating the business planning required to make that freedom point a reality sooner than you thought. Typically, we can do that in a 3 to 5 year period. But let's talk about what we did last week. So under Know Your Business, we covered the value equation, so you understand how private businesses are actually valued in a very simple, straightforward way for a business owner. We talked about the 5 phases of value creation that all business owners have to follow to make sure nothing slips through the cracks. And then we talked about 8 key value drivers and very specific actionable things inside of those 8 key areas that you could do right now to start growing the value of your company. And then to drive that home and help you understand what all of that means in the real world, we showed you a tale of 2 owners, where one owner was actually doing this type of work and planning with the team, and the other owner was not. And we talked about the differences between the two. And the last thing that we covered was how do you actually create a plan with a team to get those results. You'll always have access. We're going to cover some cheat sheets today. Some people might want to talk to our team members after this. You'll have an opportunity before we're done tonight to get the actual cheat sheets that I'm going to go over today, and also book a time to talk with us, or we have a special guest presenter as well, and you'll have an opportunity to reach out to him and his firm if it makes sense on top of it. So today we're covering phase 2, steps 4, 5, and 6. This is all about collaboration with your tax, legal, and wealth planning team. And you're going to learn that not all tax, legal, and wealth professionals are created equal. If you are a successful entrepreneur, there are a different set of playbooks available to you in those key areas, tax, legal, wealth, that are not available to, successful W-2 employees who work for somebody else. And not all tax, legal, and wealth professionals actually operate in that space. So we actually have one of them on with us today who's going to help you understand the difference between getting it right and what could cost you if you avoid some of this planning. So we're going to cover protecting your family, protecting your business, and protecting your assets. And I've got a special guest today, Jim Duggan, who is the owner of a law firm, happens to be based in Chicago. They do work nationally and internationally. He's one of the top advanced planning, tax, and estate and business attorneys in the nation. He works with several of our clients. He's very skilled at handling holistic planning in coordination with the other professionals on your team. So that would be a wealth manager, CPA, business advisors like ourselves, and creating a holistic plan to make sure that you are protecting your assets against frivolous creditors and lawsuits, that you are minimizing taxes both today while you're growing the business, but equally important later when you choose to transition, and creating a plan to actually create wealth through the business and tee up a smooth transition at some point. Not everybody's looking to sell or transition anytime soon, but we're all going to exit one way or another. And so planning for it can save you literally millions of dollars by doing things in advance. And so Jim is going to walk you through how the work that he does in collaboration with business advisors like us at Cultivate, wealth managers, works to help a business owner make really sound decisions that set up their family for success and their business for success in a way that marries their personal and financial goals to their business planning. So Jim, let me pass the presentation over to you, and we're excited to have you.
Well, thank you, Greg. I'm excited to be here. I really appreciate the inclusion. I also appreciate the collaboration with someone like yourself, because it's not often that I'm getting to a planning discussion with people who are coaching for the sale of a business. Most people are just looking on a very unitary basis towards the exit to make their money and move on. I appreciate the collaboration of other advisors to make sure we're doing holistic planning along the way. And the topic today of asset protection with your stage 4, 5, and 6 is critical, because what good is building up the value of the business to sell if you've been sued and lost your business before the sell date? What good is selling for a high value if in the end you get sued and lose all those proceeds? So asset protection is really quite critical as part of this planning discussion. So really, again, appreciate being here, and I hope this is valuable to everybody in attendance. I know we
Jim,
have
just before you,
yep.
I'm sorry, before you dig in, if you could also just tell a little bit about how the unique way that your business is structured, to kind of tee up kind of virtual family office, the kinds of professionals that are on the team, even though you're a law firm and that's all that you do, the types of professionals that you have on the team to facilitate these holistic conversations. I think that would be helpful.
Sure thing. So Duggan Bertch is a law firm in Chicago that is based on the premise of multidisciplinary planning, not only within but also without, meaning that I have a platform based on business and corporate, trust and estates, and tax planning on an integrated basis for private clients and business owners. The professionals that we hire, like me, are dual degreed candidates for the most part. So you'll have MBA JDs and CPA JDs and LLM JDs, so something in addition to the law degree. And so we try to represent our clients with an understanding of the tax, the accounting, the financial, as well as the legal. We have a lot of experience with private clients, so we almost get to serve as quasi-directors for our businesses over time, which is really quite nice. In addition to that, we work with the outside world on a multidisciplinary basis as well. We've seen a big problem in the industry where lawyers are very siloed in what they do on the one hand, and on the other hand, they're also very isolated in how they do it. They rarely want to be on a team. They're called upon to do a certain task, they do it, and they move on to the next task. So our business is really based on collaborating with CPAs, insurance agents, business coaches, wealth advisors, and the like. So that way you have a really thoughtful and cohesive plan for your private clients. And in that, we learn quite a bit together. So I get a better insight from the client because I'm hearing what Greg has to say, and Greg gets a better insight on how to exit when he understands the overall plan coming from me and other advisors. So that's the platform. It's been wildly successful, and for advisors that get that and want to be kind of all in the same boat, rowing in the same direction, it works really well, and the clients benefit from it. So that's a little bit about us and what we do, and I hope that helps. Okay. So today's discussion on asset protection, the one thing is oftentimes people think, that's not going to happen to me. It's not a real problem. I'll have insurance. So when I speak on asset protection regularly, I often update the case law that's out there, and I have these cases here just to punctuate a point. I take like the top 10 jury awards over the last 8-10 years, and I keep that on a rolling basis to highlight this. There are plenty of decisions out there and judgments that are in the billions of dollars. But if they're product liability involving a public company like a car manufacturer or a drug company, that's not really relevant to the private client typically. So I actually take a very narrow focus on the research to see what private clients have had significant judgments in the last year or 10 years, whatever it may be. And the next few pages, I'm not going to go into details of the cases. I'm just going to show you kind of a handle on what the amounts were and the type of claim, because these are all claims that could happen to you personally or could happen to your business, each and every one of them. And the amounts, as you'll guess, are really quite staggering. So we have the first case is, copyright and intellectual property infringement in a software case. It was $855 million. Again, two private companies. An Illinois case for $95 million was an individual who was hit by a falling object that had resulted in the amputation of both legs on premises, and that was a $95 million claim for negligence. A DUI car accident was $1.1 billion in North Dakota. In California, a $53 million car accident and negligence claim for vicarious liability for a truck driver, while working for the employer, injured two brothers, and the employer's, liable for that. In Washington, there's a $131 million case for, this is insane to me, a woman leaves a restaurant with her estranged husband. Both have been drinking. She gets in a car accident, is now a quadriplegic. She sues her ex-husband and the restaurant on the dram shop and wins for $131 million. So I do have clients who have restaurants and hotels and bars. These are very real cases for people like that. 2016, there's misappropriation of trade secrets by an independent contractor in a medical software business, $940 million. The accountants that were, liable for the audits for the Madoff scheme, $112 million for negligence. There's negligence claim for medical services. This is an EMT situation where someone didn't respond well to a steroid shot, so they had to call another EMT business to come. All of these are private businesses that run these EMT services. And in that delay, there was brain damage that was caused over a 20-minute period, and it's a $172 million claim. A real estate developer had a defamation suit and extortion claim for $1 billion in Florida. Sexual harassment claim for $167 million, and that was to a single employee. Oftentimes when you see those numbers, there's a group of employees that have a class action. So this is the largest single employee claim and judgment for sexual harassment. The one below, Alford and Aaron's Rents, it's a $95 million verdict. This is also Illinois, where it was sexual harassment by a manager at the company, and they claim their company turned a blind eye, so there was vicarious liability. Again, $95 million. So the point to all of that is you probably don't have enough insurance to cover any of those. And it's also to highlight that the risk of catastrophic litigation and judgments is real. And you never know with the employers you're dealing with, the independent contractors you're dealing with, the one drink too many you had, whatever it may be. You're very fortunate if you've not been sued yet. And those who do, it's too late to put the structure in place at that time. You need to put it in place in advance. Otherwise, you may be committing a fraudulent conveyance. And I have a slide on that at the end of this to talk through. Okay, so asset protection to me is a critical element of comprehensive planning. And I say in the second bullet point, it has become, in my mind, a new standard of care that if you're not talking about asset protection when you have a business owner, when you have an estate plan to do, you are committing malpractice as a lawyer. So I'm brought in quite a bit to scrub, a plan that someone has done before me and highlighting all the gaps in those plans. And it's stunning to me that we can have estate planning for high net worth clients and businesses and not give due consideration to protecting the golden goose, which is the business. And that's what this presentation will do. Okay, the asset protection planning process. For me, it's really amazing because I think it's really quite simple. It boils down to a two-step process where I identify those things that we can do to maximize our asset protection. So in addition to obviously acting in a manner that is hopefully conservative and avoiding lawsuits and carrying insurance, sufficient insurance usually is an amount really just to make sure you can pay the lawyers to handle the multi-million-dollar case with a multi-million-dollar bill and get them paid. The real goal is to have insurance for that liquidity and that coverage, but really to have a structure that enables the lawyers to let people know there will be no collection. And that's a critical piece here. So what are my two principal components of asset protection? First is maximizing what we call exempt assets, and I'll go into that. And two, transferring all your non-exempt assets to asset protection vehicles. And that's it. So I have a group of assets that are exempt, and I'll maximize those. And if they're not exempt, I have to find a protected home for those. So there's more to each of those, of course, and let's go first to the exempt asset planning. So exempt assets are a concept that goes state by state to say, if you were to go bankrupt for whatever reason, then you have a basket of assets that in our state we will protect and we will give you back at the time of your bankruptcy for your fresh start. So there may be some certain amount of equity in your home called a homestead exemption. There may be tenancy by the entirety in your home or even in personal property that is between husband and wife owning a certain asset a certain way by title can give you asset protection. Qualified plans and retirement plans have different levels of protections based on federal and state protections. Insurance and annuities, the cash values, the death benefits, those can have protection in your state. 529 plans can be exempted. And then the et cetera goes to state by state. I love some of these old laws. It's always fun to kind of, pour through them. You may have the ability to keep a cow, 2 watches, and a gun, for example, and whatever your state holds near and dear for you to have a fresh start, those things are the things you're entitled to walk with. So it may be if I am allowed to have 2 watches, maybe they're both Rolexes and not cheap watches where I have a lot of value. Maybe my gun is a collector's item with a ton of value. So things to think about as we plan. We look at this list of assets and we want to make sure we maximize those assets for you. So that's a state law issue, but also note there's a federal element to this with bankruptcy. When you go bankrupt, there is an interplay between state and federal law. The federal law has recently been updated, say within the last 20 years, where we have new exemptions, and you see them here. ERISA, plans are protected 100%. Simple IRAs, SEP IRAs, 100%. That's great. IRAs and Roth IRAs up to $1 million, not 100%. The homestead exemption is only $20,000, where in a place like Florida, it may be unlimited. Texas, it may be unlimited. Illinois, may be $30,000. So it all depends on what your protection will be, based on the statute that governs. Life insurance cash values in some states are fully protected, like Illinois, like Florida. Federally, only $10,000. So you can see what happens here with the differences between the state and the federal. Which one will apply becomes a fundamental question. And state exemptions will apply in a federal bankruptcy case if the state has what we call opted out of those federal exemptions and says you will apply our state statute instead. So you need to be aware of both when you go through a process to see which applies. And as you can guess, that leads to a fair amount of forum shopping. When you look at something like this is two simple examples. 529 plans, for example, are protected if you in the last 2 years put assets into a 529 plan. Federally, they'll only protect 5,000 of that within the 2-year period. If you had assets before the last 2 years before you went bankrupt, then the rest is protected. In Nevada, a 529 plan is fully protected. In Illinois, it's not protected at all. IRAs, you have federal bankruptcy code has $1 million limit, as I said, but Illinois, you'll be fully protected. Maine, not protected at all. So you get a sense why it's important. I know we have a lot of people on this call from around the country in different states. The first thing we do is we go through that state analysis to see what applies to you and then what can we maximize. And then that is done on a financial basis to make sure these are the appropriate assets that you want to have and maximize. And then we will do so. Now, when exempt asset planning is either not available because you don't have a good statute, or it's not desirable because it wouldn't fit into your financial scheme for whatever reason, then the remaining assets are what we call non-exempt assets. And we have to find a home for those that gives us protection because they're not inherently protected in any statute. And that's where, sadly, you have to hire someone like me. So you have fees involved with creating those structures. You don't have fees when you have assets that are just inherently protected, like your homestead. Okay. So with non-exempt assets, what are we dealing with? Again, it falls into a two-part structure. I have either limited liability entities that I'm working with, LLCs, LLPs, or LPs. There's an alphabet soup of limited liability companies that we can use. We will talk today about LLCs, as that is the most popular and most common form. And then you have asset protection trusts. So limited liability entities of some form, or asset protection trusts, which are trusts that have protective elements in them different from the business protections you might see in a corporate statute. And we'll talk through each of those. And by the way, and it also may be a combination of the two, and quite likely will be. All right, asset protection with LLCs. Asset protection with LLCs, this is the core schematic to understand and why we love LLCs at a minimum. It's very easy and what I would call the no-brainer of asset protection, that if you have non-exempt assets, at a minimum, please at least put them into an LLC holding company. It gives you protections you otherwise wouldn't have. So for example, if I have a client, up here I have parents, to the left, and I have children to the right, because I'm calling this a family LLC, where we're including everybody, but let's just focus on the parents right now. If parents have public investments held directly, a securities portfolio held directly, and they get sued, well, what will happen is very easy to freeze and take over that account and have it turned over to the creditor to settle out your claim. We freeze accounts all the time. And it's an easy process. If I have a judgment against the individual parent and I see that we have a bank account, we have an investment account, I can put a freeze on that account and I get a turnover order, and those assets become mine with no hurdle in the way whatsoever. So what we're trying to do is we're trying to create a brick wall between the parent and the assets that someone can't get over. So the idea of these LLCs is we create a holding company for the asset itself. So if we just focus on that idea of creating an LLC to own the public investments, you'll notice a difference. If I were to sue these parents and win, in the first case, I can freeze the account and take those public investments. In the second case, I have to stop for a second because the judge is going to say, whoa, 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 these parents don't own those investments. What these parents own is an interest in an entity, reflected by a piece of paper that says, I own 50% of this entity. That's what they now own. They don't own the public investments that are the attractive assets I want to get to because of their liquidity. They own an illiquid interest in this private company. That's a piece of paper that has a lot of restrictions at the entity level as to who those interests can be transferred to. In addition, under the laws, the judge will say, if properly enforced, I'm going to give you this thing called a charging order. And the charging order says that the creditor here who has sued the parent, the creditor in the triangle sues the parent can't get into the enterprise, can't get down to the underlying public investments. Rather, they're on the outside looking in, stepping into the economic shoes of the parents, and if and only if the managers of this LLC, which happen to be the parents, decide to make a profit distribution up to the parents themselves, then and only then will that distribution go to the creditor to pay out that claim. So the problem with that whole structure is the parents control the decision to make that distribution. The creditor does not control that decision. The parents, of course, will not make that decision to distribute any profits out to the creditor. The creditor is on the outside looking in, cannot compel any distributions, can't vote the shares, can't control the assets of the entity, can't foreclose and attach on anything, can't do anything legally to force the payment of their judgment. And what makes it worse is, while it's unsettled in law right now, there's an argument and a threat to that creditor that they may actually be forced to pay the taxes of the charging order holder that they sue. So if they step into the parents' economic shoes, they may have to pay the taxes on any of the income that's flowing through, even though there wasn't any profit distribution. So LLCs provide us with this brick wall that we care about. LLCs, like corporations and all entities, provide this brick wall. You know, if I have real estate over here to the lower right and I have a slip and fall and someone goes to sue, they're not able to get through the company to the owners and their other assets. This brick wall stops that. And that's the same for any corporate company is going to limit the collection of the asset itself or the business itself. So here with LLCs, unlike corporations, what's great about LLCs is we actually have two layers of protection, not just the one. We have the statutory protection that all business entities have, but we also have that second tier of the charging order protection at the top. Okay, so LLCs rely on that charging order protection, and at a minimum, if you take one thing away from this from an asset protection perspective, at a minimum, please create an LLC holdco to own your stuff. As you'll see in the following slides, there's a lot of iterations off of that theme, and as we build to the overall schematic, you'll see how we layer them in combination with other things, but that basic theme is important for you to get today. Okay, so the charging order statutes, very quickly, they fall in two camps, one being the non-exclusive remedy statutes, which are terrible, which would be in Michigan, Colorado, Illinois, where the courts may charge the interest as the statute says, and then in B, the statute either allows for other remedies as well or is silent on the matter entirely. The exclusive remedy statutes in those states, Alaska, Nevis, Delaware, and Cook Islands, so you have onshore, offshore, a court may charge an interest, they say, but it also goes on further to say in B, this is the sole and exclusive remedy available to creditors of a member. So we're looking for exclusive remedy statutes, and we're trying to mix and match the right jurisdictions to match the client circumstance. All right, I have a sample LLC planning structure here, and there will be many that follow. I want to go through quickly just to give you a little survey of some of the options. And here's the basic one, which would be, I want to have an interest, have an investment in an LLC, let's say already with third parties. A lot of people will say to me, oh, good to hear. I have, my business with my three partners is already in an LLC, so I'm fine. That's actually not true. You need to have an LLC for your own stuff. And this is showing how that would layer in. So client would have their own LLC owning their limited liability company with the third parties. And this could be an operating business. This could also be an investment company, a real estate venture with a bunch of parties where you're passive. If you get sued, if you look to the right, if you don't have the LLC, here's what will happen. The LLC will distribute profits up to all of the owners, and you're being sued. If you're being sued, these other owners are not motivated to not get their profit distributions because you have some lawsuit on your hands. So you are going to have deaf ears when you say, hey, everybody, would you mind not distributing profits ever until I get this creditor to go away? There's no real leverage there for you with them, and you lose your leverage with the creditor. So if I win a charging order against a client who's got an LLC that makes profit distributions where there's others, I love that charging order holder. situation because I'm going to get those profits. They're going to pay out, and I have a lien on those profits, and I'll take it. If instead you go to the left and I've layered in my own LLC, now what happens is the first LLC makes the profit distribution up to the third parties and to my own LLC. And I don't have to worry about the third parties at this point. It goes to my LLC. It's not going to the creditor yet, though. Then the creditor has to try to go through me to the LLC to get those assets. Well, that's where the charging order now kicks in, because this one I can control. Whereas I can't control this one, I can control my own LLC. So very typical, I want to have my investment holdco, my company holdco around my things, and that's a good starting point for all of you to understand. Where I have international assets, there's a theme here. I will talk internationally. If you're talking asset protection, I'd be remiss if I did so without talking about foreign jurisdictions, as they have some very good laws, and in fact, in many cases, better than ours. So oftentimes I will have international assets, an international joint venture, international real estate. I have a clear bias towards owning my international assets in international structures. So here, I would use that same international LLC, but I would have my foreign assets owned by the foreign LLC, thus having me benefit from an international charging order. I've removed myself from the US jurisdiction, and I'm borrowing a statute in a jurisdiction that probably has even tighter provisions with respect to charging orders than we do in the States. So oftentimes it may be a liquid portfolio. It may also just be a business interest that I have, again, or specific assets like real estate, but all of that can be owned in a foreign LLC just the same. So I try not to bring in the US courts and their jurisdictional reach where I don't have to. So I think it's ill-advised to have foreign assets or investments or income flow that you bring back into the US to then try to protect when you never needed to bring them in the first place. Okay, there is a great distinction in LLCs between single-member LLCs and multi-member LLCs. In general, you may hear people say, oh, a single-member LLC affords you no protection, whereas a multiple-member LLC does. That is based on case law that has come down in many states, and many states that is a very true statement. It's not true in all states, it's not true in all fact patterns, but it is true that single-member LLCs have vulnerabilities, whereas multi-member LLCs, you'd have more confidence in that charging order protection being upheld. A lot of people do, however, like to have single-member LLCs for planning purposes because they can be disregarded for tax purposes. And a disregarded entity for tax purposes means you don't have to file any taxes, no tax returns. It all flows up to the owner and is reported on the owner's tax return. Whether that owner is an individual or a trust or a corporation or another LLC is irrelevant. It's disregarded and it just goes up to them. So a lot of people prefer single-member LLCs because of the ease of tax compliance or the lack thereof and saving costs in that regard. So I have a wonderful structure here that tricks the system that I've used for years. I call it the multi-member single-member LLC. It gives you the best of both worlds. You can see in the schematic I've got two members. The creditor here, the client here has transferred by sale or gift some of the interests in an LLC that they were a single member of to a grantor trust for tax purposes. This trust could take many, many forms. All you care about for this slide is that it's a grantor trust, which means for tax purposes, this trust is viewed as the client for reporting. So the IRS looks at a structure like this where I have the client, the taxpayer, who sets up a trust that is effectively the taxpayer. They look at this and don't distinguish between the two, and they just see one owner. So for tax purposes, I've got a single member LLC, and therefore I don't have any tax compliance. But for legal purposes, I've created a multi-member LLC. Client owns X percent, and the trust owns Y percent. So under the statutes, I now have a second member for asset protection purposes. So if a creditor is trying to sue the client here, it's now been reinforced and made better because I have this trust over here as a second member. So it's a way to get the best of both worlds by having two members, but yet for tax purposes, it's viewed as one. All right, I still to this day get a lot of inherited corporations. A lot of people have corporations for whatever reason, either they're legacy corporations or their advisors still form corporations, or they're into a business area, they want to go public, or they're planning for a venture capital, private equity investment, and the corporate structure is what they want to go with. There's a lot of reasons that still happens. All right. I don't like those because corporations, just so you know, don't have charging order protections. So when I have a private client with an operating business that's a corporation, one of the first things I say is we got to change that. If this is a long-term business and not something you're going to sell in 1 year, or you're in the process of selling, you're exposed because if you get sued and you own corporate shares, the creditor can just take those shares entirely. They get the voting rights, they have the economic rights, they can take over the business, they can fire you, they can sell all the assets. That's the problem with corporations. So what I always want to do is I want to convert that corporation to an LLC, and I have two ways to do it. The first is here. I can do a tax-free reorganization of an LLC to a corporation. I'm sorry, these both say single-member LLCs. That's irrelevant for this purpose, but I can convert from a corporation to an LLC if it maintains that same tax status. So if I have a C corporation, I can go to a single-member LLC taxed as a C corporation, for example, and I can do that tax-free. A lot of times, though, that is too difficult to do because of employees and accounts and ID numbers, licenses. So people don't want to do that. So the easier path is I take my operating business, and let's say it's a C corporation down here in the red, where I have no charging order protection, and I simply create that holdco we talked about before. I create a holdco where I may have multiple members owning that LLC that now in turn own the corporation. So now by doing so, I have my charging order protection at the entity that now owns the entity without the charging order protection. So if a client is getting sued, they still have to go through that brick wall to get to the LLC to get to the corp. So a very simple solution. If any of you on this call have a corporation, we can fix it by having an LLC holdco on top. Some of you may have series LLCs out there. That's fine. There's been regulations that have come down where we're realizing they're not as great as they were intended to be. So what I often do instead is I create a holdco that is a multi-member holdco, giving me my asset protection and my charging order, where I have my tax compliance, and then I have my single-member LLCs underneath that holdco. It gets me to that same spot where I've got everything under one. I'm not reporting for each of these single-member LLCs in the red. I do have reporting at the one entity level, whereas if I had a series LLC, I would have to do, a return here, return here, return here, return here, return, A through E. I have to do all of those LLCs. So we fixed that structure by using the LLC holdco, again, multi-member with the single-member subs. Gives you asset protection at each subsidiary by walling them off, but also gives you better asset protection up top by having a multi-member LLC. I use this for a lot of situations where people have franchises or they have real estate where they have, someone's got 5 Dunkin' Donuts or they've got 5, rental properties they have and they own those companies 100% and they may be corporations and they may be their own LLCs. I fix that by creating a multi-member LLC at the top. Okay, so that's just a smattering. Obviously, it's based on your facts and circumstances, what the ultimate structure will be, but it gives you a sense of how you can use LLCs as that first option of dealing with non-exempt assets. How would you plan for them? So the LLC is a business solution. There is this remedy out there called a charging order. It's not a good one, and so creditors aren't really inclined to get it. In fact, they may be penalized if they do. All right, going to asset protection trust, why we love asset protection trust as option 2 for planning for non-exempt assets is whereas the LLC does have a remedy, it's just a bad one, with asset protection trusts, you'll see because of this thing called the spendthrift clause, there is just no remedy for creditors to collect. Properly structured, properly implemented, there is just no hope to collect. So there is no lien on future profits. There is no charging order threat. It is not possible, properly formed, properly enforced, that there's any way that creditor is getting a distribution off of the trust. That's the idea, okay? So those trusts come in many varieties, just like the LLC structures have many varieties. The trusts we have can be domestic, meaning in the US. They can be offshore, of course. You've all probably heard of the phrase offshore trust planning for asset protection. They can be self-settled, meaning you're setting up the trust for your own benefit, or they can be settled for third parties. All of them have their pros and cons, but done correctly, all of them have some element of protection. And between the two, I would say asset protection trusts do afford you higher protection than LLCs because you have the no remedy versus some remedy. The spendthrift clause, just so you know, if you ever heard that phrase, it's nothing too elaborate, and the legalese isn't that confusing. It basically says no interest under this instrument shall be assignable by any beneficiary or be subject to the claims of his or her creditors. And by the way, including claims for alimony or separate maintenance. So when you're planning for kids and you create trusts that are gift trusts, you are also in effect creating a prenup for them. So we do a lot of family planning with trust planning where we're not only protecting the asset for the parents, but by default, we're creating an asset protection trust for the kids, and we're actually creating prenups or postnups at the same time. So you can imagine we have quite a bit of success with trust planning for asset protection at different tiers of the family, different generational planning, and on the marital front. Okay, so just like we have the schematic for the LLC planning, on the trust world, it's simpler. You see you have a settlor who's going to transfer assets to a trust. These are the assets down here in the gray oval. You're going to transfer the assets to the trust, and you're going to have a trustee who manages it instead of you with the LLC where you're the manager of the LLC. Here you have an independent trustee, and you'll have a trust protector that has powers over the trustee to make sure no one's going rogue. This trust structure is going to be the same for a domestic trust as an international trust, be the same for an irrevocable self-settled trust and irrevocable third-party trust. They are all irrevocable. So whereas the LLC form, you can put assets in, take assets out, you can form it on day one, you can take it down on day two. Here, you create the international or the domestic irrevocable trust. It's meant to be irrevocable, at least by design. Now, for what it's worth in practice, the assets can all be distributed out and you can basically make the trust useless. But when it comes time for someone to attack you, it's because it's irrevocable, because you have an independent trustee, because you're a discretionary beneficiary off of that trust. All of those things compound to say, creditor, you can't get to this. Now, there is a split, between the U.S. versus the offshore world. When I started practicing law in the 90s, there was no such thing as a U.S. Asset protection trust on a self-settled basis. Only international jurisdictions created that type of a statute and allowed people to go create a trust themselves. So internationally, you had, if you look at all these bullet points to the right, the ability to create a trust for yourself. And they just said, as long as you're doing it in a time of non-duress and you're not committing a fraudulent conveyance, you have the right to put assets into a trust for your benefit with a trustee in our jurisdiction. And we'll gladly protect those once you get through a certain statutory period. As long as you're not committing fraud at the time and you season it and it gets through a period of time, then it'll be protected and we will not let this trust be pierced. That was created offshore. And they have other rules, by the way. They don't recognize U.S. judgments. They don't recognize U.S. lawyers. They don't allow contingency fees. They require a bond. If you're going to sue, you got to pay up front. The loser pays the victor's fees. You can flee from jurisdiction to jurisdiction. The fraudulent conveyance analysis is much more lenient. The laws are 1 to 2 years, not 4 or 10 years. The higher standard of proof is more a criminal standard of proof versus preponderance of the evidence. So internationally, you can't touch the power of those trusts in a self-settled comparison. But we did have in the domestic front, the evolution of domestic APTs has happened since I have been practicing, and we now have 19 states that have followed suit, and they have created self-settled spendthrift trust statutes. There are concerns and there are vulnerabilities under the full faith and credit clause of the Constitution, under the conflicts of laws analysis, and not surprisingly, there are already cases that have emerged, all bad. Okay, so California, Massachusetts, and Alaska, all of those have had bad cases with respect to domestic APTs. And not that there aren't cases that are troubling with respect to international trust, but as far as getting to the assets, different outcome in each case. So it hasn't been as successful, but they're better than having nothing, as I tell people. Well, you'll see my last bullet point here, though. If I am doing a domestic APT for a client, I will often say, well, let's just at least layer that into an LLC and stack the two. So at least I've got two arguments as opposed to just one that may fail if I'm in California, for example. So it's beyond the scope of this presentation today, but we do have domestic APTs from a self-settled perspective. They're not as good as offshore, but they are better than just the person owning assets individually. Third-party trust, on the other hand, if I have this trust as a third-party trust, I've created a trust, whether it's U.S. or offshore, for the benefit of my kids, my family, and I'm not a beneficiary of that trust, I'm just truly making a gift, that's a different story. I don't have to worry about the self-settled issues. Even in the U.S., that trust is protected as the same as it would be offshore. So we do quite a bit of structuring around our companies and around our proceeds from a sale, where we are including irrevocable trust for the benefit of children, because that is as protected as you can possibly get. Okay. So how do I deal with that internationally? If I have, the concerns, if I do talk about international trust, people often get concerned. So just quickly, I just want to highlight what we do here to help people understand that, because if you say, well, I don't know if I want to go to the Cook Islands and give my assets to some trustee I don't know in the Cook Islands, will I lose those assets? And so what we typically say, well, that's really not how it works. Structured the right way, you'll see that the trust, the green hexagon here, yes, that trust is going to be domiciled in the best asset protection jurisdiction possible for your purposes, and that may vary. It could be Cook Islands, it could be Nevis, it could be Belize. There may be different reasons why we're going from one jurisdiction to the next. The assets will be in a different jurisdiction, so a different financial jurisdiction. It could be Switzerland instead of Cook Islands. It could be Singapore. It could be Bermuda, Caymans. These are all really highbrow financial jurisdictions. So we separate the assets from the jurisdiction of ownership. We're just using that jurisdiction for its protection rules, and we're using other jurisdictions for their financial infrastructure. So we split those jurisdictions. We also split the trustees where appropriate. We'll have an administrative trustee in the jurisdiction where we need the local agent and we're getting our protection, but a real managing trustee, if we have someone actually managing the assets directly, as I'm showing in this schematic, that may be your Cayman Islands trustee, that may be your Bermuda trustee at a very reputable bank where you're not concerned about someone taking off the money. We always have a trust protector. Trust protector has the ability to remove the managing trustee, the administrative trustee, to work with the beneficiaries and kind of make this keep working without the client having direct involvement. We have an independent third party to make sure that nothing's going wrong with the structure. That being said, what we typically see is the next slide is that same idea, everything's the same except we layer in an LLC. Very typical in the offshore world. You have a foreign trust where you have a trustee, as we've already laid out. But then what I do is I create the LLC under the trust that owns the assets. So I'll have another jurisdiction here, and I'll have my international charging order protections we talked about underneath that trust. But this is going to have a manager, and that manager can be the client. So I bring whereas my client isn't involved with the trust and I have a trustee, if I have the LLC underneath, then my client can step in and actually have control. So it may be a situation where people feel more comfortable having the LLC under the trust, because then they can open the accounts, they can sign off on documents, they can enter into the joint venture, whatever it will be, as manager of this LLC, and never really have to involve the trustee. But if you get sued, someone's going to have to try to pierce this trust to get to the asset, which they won't be able to do. Okay. Also on the international front, as we talk about asset protection, Greg mentioned earlier, and we talked in advance of this presentation, we want to talk about tax planning as well. And this is the first slide that goes into that, and there'll be a theme that follows. But it is important to realize that tax savings is asset protection. The biggest creditor we all have is the known creditor every year taking maybe 40% of our income, right? We sell a business taking 20% of the proceeds. So part of our challenge is not only to protect our assets from the outside world of creditors, but also to try to minimize taxes and keep more of what we've earned and put that into those protected structures on a tax advantage basis. So it's very typical when I am dealing with planning and I have a portfolio, let's say, where I have tax inefficient investments. Let's say I have a hedge fund that's kicking off, great income, or a REIT or something like that, or I want to get into those types of portfolios, one thing you'll see we do is we'll have that asset protection trust, as I've outlined before, which gives you all these protections in these bullet points to the right here. But instead of having it own the portfolio directly, I'm going to layer in between the trust and the portfolio an insurance policy or an annuity policy to take ownership. What this does is this life insurance or annuity policy, properly structured, where you have proper diversification, no investor control, it's tax qualified, there's things that we have to do to make this right. But if we do that, we're creating a tax-free wrapper or tax-free owner of that portfolio. So given the option of having a taxable portfolio or a tax-free portfolio, most people would opt for the tax-free portfolio, with one proviso: the cost of the insurance or the annuity should be less than the taxes you would otherwise pay. So these are structured in a way to meet that formula in a way that's, to the favor of the client, where the arbitrage is in your favor. For example, let's say you had 10% returns on your portfolio and you would have a 4% tax to pay at 40% on some inefficient hedge fund structure. If the fees of this policy were 1 or 2%, that differential is what you're going to benefit from. So you might earn another 2 points a year by having it in this tax-free structure. So you're swapping out taxes for costs, and as long as the costs are less than the taxes, this would make economic sense. So very typical for me with clients to say, okay, we're going to have an international trust or even a domestic trust, and we'll take that portfolio and put it into a life policy or annuity policy. Same idea before, we'll have one jurisdiction for the trust and a different jurisdiction for the insurance company, and a different jurisdiction for the management of the assets, as we talked before. But what this does is this creates, to the left here, a tax-free, asset-protected structure, which is our ultimate objective. So if we can do both, and we can avoid, certain compliance issues because it's tax-free, it makes life a lot easier. Investments that are in an insurance policy or annuity that have K1s, where a lot of us, unfortunately, we have investments in private structures or private funds that kick off a K1 that we're often waiting on and is tying up our entire return, or very much complicating our return, because we have so many K1s that we have to report. By wrapping those types of investments in life insurance or annuity policies, you avoid having to report those K1s and aren't waiting on those for your reporting. So a really nice structure where you combine asset protection with greater accumulation of wealth by virtue of minimizing taxes. And that's the goal for everybody. Another thing in that same vein is there's a thing called a captive insurance company. It can be, again, onshore or offshore. The way that works is I have down low in blue the domestic operating companies for a client that will likely have risks of all kinds: employee risk, third-party risk, societal risk. It could be economic risk, business interruption, whatever it may be on the business and the time. People have insurance. They buy insurance, and there's a lot of things that they don't insure. So properly done, where we do an independent appraisal and valuation actuarial study to see what kind of risks do you have, could we justify creating your own insurance company to render coverages to your own business, rather than going to Chubb or State Farm or whoever. You actually create your own insurance company in the red to provide insurance coverages to your operating company. Why is that interesting? That's interesting because when you make your premium payments up to your insurance company, just like you would with Chubb or Allstate or whoever, this would be a deductible premium. So you're reducing your income and your income tax at the operating company level by sending that premium to the insurance company, taking a deduction for it. Ultimately, from a tax perspective, done right, that what would have been ordinary income goes to the captive and can be taken out at qualified dividend rates. So you may switch from a 40% rate down to a 20% rate just by doing this structure. Again, it's got to be real. You have to have real risks. You have to have a real insurance kind of structure behind it. But structured properly, you take what would have been ordinary income at your blue operating company and you bring it in as income here. Ultimately, that's going to get washed through as qualified dividends, where we saved all those taxes. So there's a nice tax play here. But why I wanted to show this is, as we're talking about combination of tax planning and asset protection, two things on asset protection. One, and very importantly, this fair market value transaction asterisk to the right of the operating company. is really critical. When I pay my premiums in exchange for coverages, that is a fair market value transaction. When you pay for insurance coverage from a Chubb, from an Allstate, that is a fair market value transaction. They're creating a premium and quantifying that. You pay it, and in exchange, you're getting some coverage for a year, and then you do it again and do it again. So you're doing the same thing. Why is that important? Well, if you have a fair market value transaction, a creditor can't claim that that is a fraudulent conveyance. One of the first elements to fraudulent conveyance is that you have transferred something for less than fair market value when you're talking about the objective test of fraudulent conveyance. So by structuring this to be a fair market value transaction, I'm not transferring anything for less than fair market value, and I can keep doing this even if I have a devastating lawsuit going on for years. And by the way, devastating lawsuits go on for years, 5 years, 10 years. And so if I have a captive set up and I'm having that lawsuit hovering over my head for the, whatever the long period of time will be, the entire time I have that, I can be sending premiums away from my operating company into a protected structure. And I can do so without them stopping it because it's in due course of business and it's a fair market value transaction. My second tier of protection is that company would in turn be owned by, guess what? An asset protection trust or an LLC or a combination of the two. So a great way to transfer assets, even during a time of duress, to a protected structure to get assets into an even more protected structure away from the business. All right, I'm not going to go into great detail on this. This shows you how we integrate. I mentioned before, the whole point is multidisciplinary planning, comprehensive planning, integration. This is what your overall schematic ultimately looks like. We're taking assets that are exempt up here, and we have them owned to protect you, like retirement plans, putting a home in tenancy by the entirety, or leveraging homestead exemption. We'll have, asset protection trusts for the kids that are a third-party trust, self-settled trust, maybe international, the private placement insurance talked about, having a holding company LLC that owns various businesses and other risky assets, maybe separating out a management company to separate management from ownership if there's risk there. It's just tying in all these concepts to give you a well-conceived and well-implemented structure and documenting it the right way. So if somebody sues you, they look at this and go, oh my gosh, how on earth am I going to get to this down here, this portfolio? How am I going to get to these collectibles? I just can't. I can't get there. So this is what real asset protection, integrated asset protection planning is about. All right, I want to go through a case study and talk to some income tax planning stuff as we integrate these issues. Very simple schematic versus the last one. The idea here is to show what a typical client might look like coming to us. And this is really very simple, but very typical. If someone they're married, they may have a 401k with $400,000, let's say, an IRA with $400,000 between the two spouses. We have assets that are owned individually. That's why I have lines just going directly from the individuals. This is very typical. Assets owned individually. We're accumulating cash. We're making money. We have investments of $3 million. We have our vehicles, a couple of nice cars, and we have personal property in the home worth $200 grand. Have a home worth $1.2 million owned individually. Corporation as the business, we're $25 million. Thanks to Greg. And then you've got rental real estate, let's say, life insurance that's out there too. So this is the kind of asset mix you might see for someone who's got a business that's booming or growing and hoping to sell, and they're accumulating wealth around the fringes on this. So this is typical, and this is awful. So what we do is we try to rework the balance sheet for everybody to go from what would have exposure for them to something that wouldn't have exposure, and what might be really taxable for them to something that might not be as taxable. So in the first instance, so in total, here's what I might do. I'll go back. This is what it was, and this is what it becomes. Okay, so someone takes these assets they own individually. We're going to now do our planning to hit our hot buttons from a protection standpoint and minimization standpoint. And here you go. Now I've got spouse one and spouse two just the same. Some assets are going to be owned individually. They're not a big issue. I'll have small amounts of cash under the small probate exemption in the state. The vehicles will keep owned individually or maybe in the trust. I tie my IRAs, which are still protected because they're exempt, ultimately to a family foundation to minimize tax and to have further protection. The home would go from the individual ownership was before in a tenancy by the entirety between the trusts, so I avoid probate and I have asset protection here. I would create an LLC for their portfolio assets. I'd create combined ownership of the business, the corporation now having LLCs over it to have that LLC protection we talked about. The rental real estate LLC would separate out that rental real estate to protect that and the risks attendant to that. And then that would be owned in turn by the LLC for the gifting side, which would be owned by a third-party gift trust. That would be removed from the estate and would be fully asset protected as an irrevocable spendthrift trust to a third party. And then the insurance, which may or may not be protected in the state, depending on state law, I will set up an insurance trust so that way the proceeds when they come out will also be protected. So that way when the proceeds are received, it isn't $2 million as we had here in this case, going to the children directly to go squander or get sued and lose or go through divorce and lose. Instead, the assets go into a trust that are fully protected, serve as a prenup and all the stuff we talked about before. So that way we capture all of that. So I go from that to this. And what you'll see the effect of that is on the asset protection front in the first instance, and this is a real client fact pattern. This is not made up. This is what we've seen, and it's very typical. I had 97% of my assets in the first instance are not protected at all. They're just owned and they're exposed to creditors. I had a few that were. The retirement accounts were protected either under ERISA or under state law. Illinois Home was based on the homestead exemption in this case, and life insurance, the cash value is protected in Illinois as well. So in this case, I had, of $32 million, because the business was the lion's share of it, 930 was protected already and nothing for me to do, but there was 32 million not protected, so it was 97.3%. By virtue of layering in the LLCs that we showed you and crediting tenancy by the entirety and having assets go to the foundation, we were able to change that from 97.3 to 1%, 99%. And this is where you want to be. When you're done with your quote unquote estate plan, you should look like this. You want to be as protected as you can possibly be. Sometimes, based on your business, we have problems that you can't protect it. You may be a physician that has to own a practice in your own name. So there are things like that we have to deal with, but then we got to really work hard on all the other assets. But our goal is to get to something like this if we can. On the tax front, we have a similar goal. Before the recommendations, you have under today's laws, and the laws may be subject to change. Right now, we have a wonderful law that has been increased so that from an estate tax perspective, you may or may not be aware of this, but you each have, and starting, right now it's about $12 million. You have $12 million of an exemption that if you die, you don't have to pay estate tax on $12 million of assets. If you're married, you can double that. So that's a $24 million exemption. So in this case, you have a $35 million estate, and you have a $4 million exemption. You have 11 million plus, of taxable assets. And when you do the math on that, then maybe something like $4.5 million of tax. But with the planning we do, as you saw in that schematic, not only does it help us for asset protection, but we're also creating LLCs, and we're also making wealth transfers, and we're also using those irrevocable gift trusts. What happens is we're removing assets from your taxable estate, either by virtue of discount planning with the LLCs, contribution to the family foundation, or gift into the trust, or gift outright of the asset if we move it to the downstream kind of structure for the next generation. And what you have here is it's a wonderful structure where we moved $14 million just by virtue of our planning away from the parent's estate, so it was no longer taxable. So now we had $21.3 million taxable at a time when we have $24 million of exemption. And so now we have zero taxes, and that's also where you want to be. So there's a combination here of protecting assets, not only from creditors, but also from the government. We're trying to pass our assets on to our kids, and usually want to maximize that, or to charity, or whatever it may be. And minimizing taxes to the government is one good way to maximize those assets moving downstream. Okay, quick word on fraudulent conveyance. I mentioned before. First of all, don't do it. The issue is if you've started to do your plan, if you're getting sued and you start to make your transfers, then it is too late. Oftentimes you have a problem there, and you're going to have those transfers unwound because there's a look back, as you can see, within the states, 4 years and maybe 10 years federal. So things that you think you're doing to be cute may be unwound, and you may have a bad lawsuit on your hands if you're committing a fraudulent conveyance. There's different tests for that, the subjective test, you intended to do it, or the objective test. They don't care about your intent. Did you transfer something for less than fair value and you were insolvent to pay the debts? So that's a tough thing for people to realize is the objective test. It doesn't matter what you meant. It just matters that it happened. And that's why we want to be careful in our structuring where we may want to have, fair market value transactions, for example, or more importantly, the other message to learn from today is to plan now. You don't want to wait until you get sued. You want to plan now. You want to plan now before your business goes up. You want to plan now when the value is low, because if it is unwound, it's a smaller amount. For tax purposes, if we make a transfer, it's reported a lower dollar amount. So planning now is always better than planning tomorrow for assets that are appreciating. Okay,
Hey, Jim,
income
this is
tax.
Greg.
Yeah.
Jim, before you go to the income tax, that look back period, is that just on a look back to when you personally might have owned it versus if somebody, like a very common thing that I have with clients, they're building a successful business. Oftentimes there's an offshoot that comes, a product innovation, some type of innovation that they're going to build in parallel. And if they were doing the proper planning at the beginning and never took interest ownership personally, but instead followed a blueprint like yours, what does that mean anything to those look back periods?
No, so I mean, let's take the client. If I set up a new business, which I do quite a bit, with in the kids' names, right? I have a trust set up. It's starting at zero value. We set up the company. It's in the kids' names, meaning in those trusts, and the trust or the LLC owns the business, and it's not my asset. And I get sued. There's no claim. I get sued. 5 years from now, 10 years from now, 20 years from now. There's no look back for that. The look back applies to the asset that the person who got sued transferred. So it's 4 years, 10 years from the transfer date.
So how you choose to hold your ownership interests matters. I think it's just a big
matters a ton. As you can guess, all of you listening for my presentation, that I'm not keen on individuals owning a thing. It's the first thing I tell people. I'm like, I may like you personally, but I hate you when it comes to planning, right? I'm trying to minimize individual ownership of stuff, and that's evident from my schematics. And that's how you know that you are protected. Okay, I'll spend a couple minutes here and then I'll be done. Income tax minimization is also important. We're talking about estate tax minimization, how helpful that can be to maximizing assets. Income tax minimization is a very broad statement, and we all want to minimize income taxes. It's very complicated and very layered, very fact specific for everybody, and also depends on not only your facts but your risk profile. I do overuse this phrase on purpose, but I say that do not let the tail wag the dog. Do not let the tail wag the dog. It's got to make sense. It's got to be defensible. It's got to fit your fact pattern. But to the extent you can, and the opportunities are there, well, that's you should take advantage of what's under the code to help maximize and retain capital and value, because that will help you on ultimate sale. It will help you after the sale, and it's it's your right to minimize your income taxes legally. So that's it's always something that we have to be considering. Okay, just quickly, I'm high level on all these is sometimes when we have companies, you're always planning for the win, the exit, the positive, up the hockey stick, up the J curve, whatever you want to call it. But sometimes companies don't work out, and we want to make sure that we allow for ordinary losses if a corporation fails. And if we use 1244 stock in a C corp, it's one thing to be aware of that's out there to make sure that you don't have trapped losses. Losses can be valuable to you if they don't work. The rest of these are dealing with good situations though. So 1202 stock, oftentimes people have businesses that would qualify for this thing called 1202 stock if they only knew about it. And 1202 stock can actually give you a fully tax-free exit. So instead of thinking I'm going to pay capital gains on the sale of my business or ordinary income because I have some asset sale, you may be able to structure this as a stock sale in a C corp structure where you can avoid $10 million or 10 times your basis of tax when you sell that stock if you held the company for 5 years, which in most of your cases, that's the case. If you sell before 5 years, you can actually get a rollover if you were to take those proceeds and go invest in another qualifying small business, which a lot of you may do. And then when you get to the 5th year, you can sell that business, and then it's all tax-free. And not only is it $10 million, it can be husband and wife, which is $20 million. It can be husband, wife, and non-grantor trust for the kids. It could be 30, 40, $50 million. So we stack 1202 structures to avoid tax upon sale. It's a wonderful design. Similarly, you can use ESOPs, employee stock ownership plans, which can work for C Corps and S Corps. They're different though. With C Corps, it allows for not only deductions of dividends going to an ESOP, which is basically a tax-free retirement plan, but also if you're the one that's selling to the ESOP, and I just went through this with a client where they sold a $70 million business to the employees in an ESOP, that proceed qualification, when you sell that from a stock under 1042, you get a rollover in those proceeds going to a qualified securities portfolio, and you pay no tax until you liquidate out of qualified securities and then go buy your vacation home. So for people that have significant sales and have assets that they're not going to need to spend, and you're just doing an estate play, we could conceivably never pay tax on those dollars at all. We've rolled it over into a qualified securities portfolio and we just let it grow. Ultimately, it's transfer tax free to the kids. So C Corp ESOPs are another great tool for tax planning. S Corp ESOPs were introduced years ago, I think in the year 2000, where we didn't have them before, and then they said we could have them, and now there are specific restrictions on how you can do it. But man, if the fact pattern is right, you can actually create a tax-free company. You don't get the benefit of the tax-free rollover of the sale proceeds, and you don't get the deduction of dividends going to ESOP. But what you have is a flow-through company as an S Corp, where all those earnings just go to all the employees and owners' accounts tax-free. So S Corp ESOPs are a wonderful way to make money, pay yourselves what you want to pay yourselves, and then the profits flow through tax-free to the retirement structure. Speaking of retirement plans, self-directed IRAs are also a very useful tool to invest in businesses. It can't be the business that you're controlling and running, but when you start to diversify into other businesses, which a lot of you will, where you partner with other people, you're minimally involved, it's typical to take your IRA, transfer to a self-directed IRA structure, and then invest through that. Then all of your earnings are tax-free within that IRA. If you have converted that to a Roth IRA, all your withdrawals will also be tax-free. So all of these are just wonderful tools to have tax-free ownership and tax-free access after sale of a business. IC discs and captive insurance companies are ways to kind of convert from ordinary income to capital gain or qualified dividend rates. IC discs are just they're for exporters. People are manufacturers who export. You can basically pay yourself a commission. This is right out of the code to motivate people to manufacture here and export. If you do that, you convert whatever that commission rate is from ordinary income to qualified dividend rates. So you may go from 40% down to 20% or thereabouts. Captive insurance, we already talked about, same type of tax effect for that. Has to be a real insurance company, but you are ultimately converting ordinary income to qualified dividends. Defined benefit planning, a lot of people don't maximize their benefit planning contributions in their corporations. And when you have private companies, and let's say you're older, actuarially, you might be able to put away hundreds of thousands of dollars a year for you and other key employees if you want to provide for your retirement in a fully deductible, asset protected, and tax deferred, kind of structure. And you don't have to limit yourself to, the $57,000, whatever the SEP limit's going to be, or whatever the 401k limit is in your company. So thinking about defined benefit plans, cash balance plans, and the like is important, and a lot of people overlook that's out there to really help minimize taxes as you go. Stock sale versus asset sale is important when you go into your sale transaction, when you've succeeded, and we've had the luck that we were hoping to have. We will sell this thing. If we can sell stock, we're going to have capital gain treatment. If we're selling assets, ordinary treatment could be a higher tax. Depending on the nature of your business, you may pay a full 40% versus a 20%. Again, I'm approximating, but it may be twice the tax if it's an asset sale. Some businesses, though, just so you know, are largely goodwill. And if it's goodwill, we may be treating that asset as a capital gain event or a capital asset, and that would flow through as capital gain. So sometimes an asset sale may be very similar in net impact as a stock sale. All right, state tax arbitrage, running your business through various states. If you have businesses that, you can go into different areas to have different functions or different regions. Sometimes it's good to set up shop in low tax or no tax states for your business, so you're not apportioning all your income to some state that's tax aggressive. So we break up businesses all the time into tax friendlier jurisdictions. Individually, you may want to change tax residency yourselves in advance of a sale. This is a very typical tool that a lot of people use. If you're building up your business with Greg and you have a 3-year plan, well, maybe in year 2, you should think about changing residency, because if you're a bona fide resident of a low or no tax state, a U.S. territory, even a foreign jurisdiction, you can minimize or potentially avoid both state and federal tax. So people move to Florida before they sell a business. People go to Puerto Rico. People leave the country around citizenship. There's all different fact patterns, all different people. But if you are living in California or Illinois or New York or some other tax aggressive state, and you're looking to sell and your facts allow it, and it's easy enough for you to be elsewhere, you may want to think about that if you have a $20 million sale or $50 million sale, whatever it may be, moving. And there's a whole process to doing that the right way. And your facts may prevent it, but your facts may also allow it. And if they do, you want to make sure you can manage your 20-point checklist of how to satisfy that so no one's claiming residency in the state you were leaving. Also, there's charitable planning, foundations, charitable trusts, and things like that that we can use to shift income to tax-free structures or to get deductions off of income in advance of a sale or on an annual basis. So using charitable structures are very popular as well. And then plenty of others that apply, but these are all good ones for private business owners and what I typically see to have included. So, every fact pattern is different. That's why we also want to integrate with the other advisors, the CPAs, understand the fact pattern, and see what we can do upon an assessment and audit of your affairs, see are there ways we can help you minimize your income taxes as well. And with that covers all the topics I was hoping to get to. Greg, thank you so much. I appreciate the time and everyone's attention. I know it's a lot to get through, but I
yeah, no, this is great, Jim. Thank you so much. Let me take over. Give me 2 minutes to kind of simplify a couple things and wrap this up. So I'll take back the screen here. Let's see where to do that.
I've got you.
There we go. Thanks. All right, guys. So the big takeaway here is that there's different types of planning available. It is complex. This is why we say that this type of, call it exit planning, but it's just good business strategy, good legal strategy, good, wealth management, tax, et cetera strategy. It takes a team. And so that's why it's so critical that not all tax, legal, and wealth managers are created equal, just because this is a niche. And so not all doctors are brain surgeons. And if you need brain surgery, you don't go to a generalist. So getting the right people on the team. What I'm going to do is I'm very quickly going to kind of summarize at a very simple level the things that Jim covered in detail, because I just want to elevate it. And then you guys can have access to these cheat sheets if you want. I will give you a text number that you could reach out to, and we'll send it right to you. So we covered 3 areas: protect your family, protect your business, protect your assets. So on the protect your family front, 3 main reasons why most business owners struggle to figure out how to separate income and assets separate from their business. Number 1, they refuse to believe that their business income is ever going to dry up. When things are going good, it feels like the gravy train will never end. Also, a lot of owners fail to see the risk of having all their finances tied to their business. And thirdly, they're too busy working in the business to really take a step back and figure out how to create an income replacement plan. So at a high level, 3 things that you could do: stack retirement plans, upgrade insurance, and create multiple sources of income. So Jim mentioned this. He called it cash balance plans and defined benefit planning. Bottom line, if you're working with a good wealth manager, they understand how to take your 401k plan and then allow you to stuff a lot more money away. And so you need to partner with the right folks for this. On the upgrading your insurance plan, most of our clients we see just don't have the right coverage here when we're working with their tax and legal and wealth management folks. So make sure that you're covered in case of death, disability, divorce, disagreement with partners, disruption of your business, departure of key employees. There are a lot of things that we could do with planning to mitigate those risks. And then more importantly, if you just reframe your business as a wealth creation tool for you, if the business is healthy and we could carve off a couple dollars, what could you do with those dollars and that time to start having more than one horse pull the wagon for you financially? And that's, again, working with the right professionals, mentors, et cetera, who are doing the different things that you want to do, whether that's wealth management, investment in real estate, or what have you. We talked about protect your business. So why do most owners struggle to figure out how to protect their single largest asset? Well, number one, oftentimes we feel that our employees and our clients are never going to leave us. So if I got good people helping me out right now, then nothing's really going to happen there. Or we all falsely believe that it's never going to happen to me until it does. And the third issue is that we falsely believe that we're going to have enough time to handle this in the future. And oftentimes that is not the case. Over 50% of business owners do not leave their business on their own terms or timeline. Something else happens. So what do you need to do? Do a business risk assessment. Just understand where you hold risk. We help with that, by the way, if you need help. And then identify some plans to mitigate how you own stuff and where business risk is. Number two, make sure you have contingency or continuity plans. That could be as simple as identifying who's in charge if it's not you, if something happens to you temporarily or extended. Who's going to help that person, and how will you guys communicate decisions? We have tools and templates to help you quickly put that together. Step three is make sure you're working with folks like Jim and his team, like qualified wealth managers who help you put together business succession and estate plans. You need to dovetail your business, personal, and financial planning into one comprehensive plan, because if we're honest, guys, as business owners, there is no clear distinction in our lives between our business life, our personal life, and our financial life. And lastly, asset protection. So Jim, he showed you how the sausage is made at a high level, but in a very simplified version of this, I think most business owners are just unaware of the options and the massive benefits available to actually going down this path. Number two, oftentimes, as Jim alluded to, people wait till it's too late. Once you have an issue, it's too late to plan for it. And then also, people fail to see that the costs of doing it right are really investments in your future that come back and pay huge dividends to you when the planning is done correctly. And so at a high level, think about advanced tax strategies. There are various private business owner strategies that you can use, as Jim just alluded to minimize taxes now and at exit, and eventually even for estate taxes. Do something called entity-based planning. You looked at those schematics, and a simple way of thinking about it is, rather than you owning everything personally in your name, you set up the right kind of entities to own the right kind of stuff so that you are protected from frivolous creditors, lawsuits, and it maximizes your options and your privacy. And the last big takeaway, guys, is that we need to reframe our thinking about exit planning. Exit planning is not about getting you and your money out of the business at some point in the future. It's about getting what you want out of your business starting right now. So exit planning is it's like Stephen Covey. It's beginning with the end in mind. If we start a business, we have some end in mind. Let's prepare for that. Let's build a killer business that gives us time and money. Let's separate some of that time and money into other assets that give us more sleep at night, and protection for our families now, way more options for us later. And let's do it in a way that we actually enjoy and have a life that we could be more, do more, make a bigger impact in the areas that we care about, including our business. So, wanted to just quickly summarize that. If you want our cheat sheets, what I just went over, text cheat sheet 123 to 312-847-3880. Again, it's not case sensitive, but you do have to spell it correctly with no spaces. If you want to talk to somebody on our team, no cost, no obligation, just text Freedom Point 123 to 312-847-3880. We went a little bit longer today, but I think it was worth it, because most business owners are unaware of the options that are available to them. The other thing that I'll point out is that, in my experience of having multiple clients working with Jim and his team, not everybody starts and goes from 0 to 100 miles an hour with him right out the gates. Oftentimes, there is just a tactical thing that needs to be done that they work with Jim on, and then eventually, when the time is right, when they're ready to do more comprehensive planning, they can start layering that in. So we have clients who do both. So if you looked at what he showed you and said, geez, that seems like a lot, I'm not sure if my brain is ready for that, I'd also just have you consider that there's ways to start if you have a particular rock in your shoe, in talking to folks like Jim and getting that rock removed and solving that pain, but make sure that you're working with somebody who understands the bigger picture so that the way that you solve that particular pain or remove that rock, it will work for what you want to do moving forward as well. So, Matt, I'm not sure. We probably had most of the questions answered. If there were any that are in there, just shout them out really quickly. While we're waiting for you to do that, I just want to say thank you guys. We really appreciate you sticking with us, and we're really looking forward to continuing our workshop series. Next week, we're going to cover growing the value of your company. This is right up the alley for Cultivate. We're going to talk about exactly what our methodology is, exactly how we do it, and we're going to share some of our secrets of how we do planning so quickly and really simplify things. So that'd be a great one for you to tune in as well.